Mark Matthews, Head of Research Asia, Julius Baer. He joins us right now to give us his sense of what he made of the budget. Mark, great having you as always. Thanks for taking the time out. What's your first take? Is the fisc discipline a bigger winner, or is the raising of capital gains tax a bigger drag, if at all?
I think the raising of the tax is a bigger drag because most emerging markets do not tax non-residents on capital gains. I guess the only positive I could say is that the long-term capital gains tax rate, which has gone up to 12.5%, 12.5% is still a very low number compared to the capital gains tax in most developed countries. In Canada, where I'm from, it just went up to 67%. So 12.5 sounds pretty good compared to that. But net, I would say, the taxes are not good for markets, and especially capital gains taxes. So it's a populist budget. To your point, they decided not to increase taxes on tobacco, but they are increasing taxes on capital gains.
Mark, just wondering, how is that a really big deterrent? I mean, one of the thought processes that is coming in is that India wants to align capital gains taxes across asset classes, and it's very difficult to bring the taxes on some of the other asset classes lower. So you're giving a directional move that this is what it is, and they have said that this is about it. For the near term, at least, there doesn't seem to be any more tinkering. Are you, or do you think global investors will take it very negatively, or does the growth that India will provide make up for some of that disappointment?
The growth makes up for the disappointment because with a few exceptions, most emerging markets are problematic now. China, obviously, first and foremost. And so then you get to very illiquid places. Like, for example, I'll just tell you, Malaysia has a very good story right now because of cheap electricity, English-speaking, low-cost labor. And so there's billions of dollars going into data centers there. And they have quite a pro-business government and king that have taken over recently. But I mean, who's going to invest in Malaysia? It's a tiny little market. So on the pecking order of emerging markets, you really obviously have China at the top because of its size. And then after is India. So India, with its superior growth, I think, and the absence of good stories in other large emerging markets, people don't like the capital gains tax in India, but the fact that it does have a superior story to other emerging markets, yes, does make up for that.
Mark, hi, good morning. Just trying to get a sense on whether you think that this initial pinch on the capital gains tax is going to sustain for a bit, in your view, on India's performance as an emerging market short term. How do you see this pair out? And are you looking at it also in the context of a market that's really run up and needed some reason to cool down? Do you see that cool off coming now?
I completely agree that it needs to cool off. Unfortunately, I don't think it will, especially looking at the reaction in the market after the budget. 25 times trailing earnings relative to an historic average of 20 is, the best you could say is fully valued, given that the macro environment is probably better than the long-term average right now. But I don't think it deserves to trade at more than 25 times. And the earnings growth this year, we're predicting about 13%, down from 17% last year. So I would have preferred that it just build a base sideways here and catch up to let the earnings, sort of bring that price earnings ratio down to a better level. Because it's never good when anything is overvalued, be it a stock or a property or whatever it is. That being said, I think it will continue to grind higher because the domestic liquidity is so ample.
One more, Mark. I just want to understand if there is a rejig in what areas look exciting for you within the Indian markets after the budget. The push on employment, the boost or the attempts to boost consumption in the staples area, is that leading to an overall sort of review of what you think is working within the Indian equity space?
No, I have read research to that extent. I've seen people moving away from industrials to consumption. We're not doing that. The capex story, in my opinion, is unchanged. It didn't change from the interim budget, and it's clear the BJP, after the election, is maintaining its bias toward the development of infrastructure in the country. So that hasn't changed, and the consumer staples are expensive. And I would just say that the importance of the budget for the economy and by extrapolation the market has been declining over the last few years as more and more important decisions are made outside of the budget. So we have not made any changes to our investments post-budget.
Right. Mark, how much percent of your portfolio is exposed to India currently?
Top of my head, I struggle. I don't want to give you a number that I don't know. So we have exposure. It's in the grand scheme of things, I must confess, not that material. Our bias has always been, well, not always, but at least let me say the last 15 years, our bias has been toward growth, which means technology in the United States. But I will say that we like India, and if there is a pullback in India, that we will view as an opportunity.
Mark, what, in your opinion, is the quantum of pullback you would want to see to turn overweight India? And if you're buying tech in the US, does that mean you're overweight tech in India as well? So two parts to that question, right? Yeah, what sort of yeah.
We are overweight India in the context of Asia. It's our favorite Asian market. It's our favorite emerging market. We are confident India will outperform its peers. I think it could possibly even outperform the US over the next 5 years. But the US has still this very strong story that it is the, technology is the largest sector in their stock market. To my knowledge, there's no other stock market in the world that has that distinction. Most of stock markets in the world, the largest sectors are banks or industrials or consumer. And the US does technology better than anybody else. And with artificial intelligence, it's only going to become bigger. So we don't want to deviate from that. But I do think that the Indian story is a very good one. And I think I'll leave it at that.
I'm going to go back and ask you, what is the quantum of a correction that would make you comfortable to buy more into India?
10%.
Oh, lovely. So, okay, just another quick one. Does India paper look far more attractive at this juncture than Indian equity?
No, I think India is a growth market, and when you're biased toward growth, you want to be in equities. I do think that the narrowing of the fiscal deficit will result in a credit rating upgrade, maybe more than one. That'll be good for Indian bonds. But there's so much good yield all around the world, including in investment grade developed markets, where you can get upwards of 6.5% in dollars with a historic default rate of 0. I don't really see the need to go out of our way to own Indian bonds, but Indian stocks, I do see that need.
Mark, I have one last question from my end. What within India, I mean, are you changing your preference towards maybe the defensive staples? I did hear you say that you are still focusing on industrials, but that is a very wide bucket too. Is staples making some bit of a comeback, or is your portfolio positioning unchanged pre and post budget?
It's unchanged, and I think the staples are too expensive.
Okay.
So, yeah.
One more quick question. With everything that's happening outside in terms of an anticipation of a rate cut, we've talked about how the recent rally for markets like Japan, India, most parts of the US has been liquidity driven. If we do get a rate cut in September as expected by the street, is that going to give Indian markets, emerging markets, another leg up from here, you think?
No, I think the rate cuts are in the price. I don't recall what Fed fund futures are pricing for September, but if memory serves me right, it's around 80 or 90%. So when it hits the tape, I don't think anybody will be surprised at that. People are probably a little more up in the air about what's going to happen in November and December. And for the record, we are looking for additional rate cuts in November and December. So if those ones happen, maybe that could, provide more upside to markets. But the September one is in the price.
The big sort of movers you're looking at from a global markets and an Indian markets perspective next, of course, September becomes important. You said November and December as well. US elections there. And what would be the next big mover from the Indian markets perspective? Because our big events are pretty much done. Election done, budget done.
No, I agree. So we have the earnings to look forward to, and it'll be very important to monitor the margins of companies, because the big reason for the earnings expansion last year was margin expansion. And so I just don't think they can do that twice, 2 years in a row. So I'll be watching the earnings more closely than anything else.
Mark, India versus China, how are you allocating to China right now? Betting on a recovery there or still keeping away?
Well, they couldn't be more diametrically opposed. India is doing very well economically. The stock market is on fire, and China's not doing well economically, and the stock market is absolute dog. So a contrarian, of course, looks at China with great interest, and it hasn't really paid to be contrarian anywhere over the last few years. Markets have been very momentum driven, but China has a lot of pent up fiscal spending power that they could activate in the second half of this year. And I find, trying to guess Chinese policy extremely difficult. It's opaque there, but they have the resources, if they want to stimulate the economy based on the budget that was decided earlier this year. And I noticed that the June home prices in Beijing and Shanghai, the two largest cities, turned positive for the first time in 9 months. So I don't know if that can continue, but there are some potential positive things. And then beyond that, if Donald Trump's elected, I believe there's an opportunity for a reset in US-China relations, which would be very important as well. I noticed China's already trying to warm up to some countries it had very frosty relations with: Japan, the Philippines, and Canada. They've all met there, and the foreign ministers have met and said we want to improve our ties. So there's so many things that have gone against China the last few years: geopolitics, bad economy, property sector disaster. Those things, there's a possibility they could turn around, and then it is, if not the cheapest market in the world, then certainly one of them. So it's fickle, but I would say China's actually looking very interesting on a 12-month view.
All right. So China on a 12-month view. Right now, India versus China, India comes out on tops. It's I think the long-term capital gains tax negative for now, but perhaps will be absorbed by the Indian markets as well. Thank you so much, Mark Matthews, for speaking with us this morning. That's a great view.